This is our Forex blog for January 6, 2012. And like most days, we want to buy the strongest currencies versus the weakest, preferably when all the time frames line up. We statistically compare every currency to every other one. We average together 5 of our best statistical tools to come up with a real-time bar-by-bar strength or weakness. Some of them measure the direction. In this case, the dollar's moving versus all the rest of them. And some of them also measure the intensity, statistical intensity of that direction. So anytime you have a currency with a plus reading at and above the 80 level, it's very strong. Anytime it hits plus 100, that trend usually continues. And you can see after a little bit of a pullback, it did. A little bit of a pullback, it did. A little deeper pullback, it did. And then we had a counter trend move. When the strength gets less and less and less, then it becomes less likely to predict. Usually when you see a lot of strength followed by less weakness, that strength will continue, especially if the weekly trend is in that direction. Underneath the real-time one, we have the daily, weekly, and monthly. So the weakest longer-term trends are the euro and the Swiss. Some of the strongest longer-term trends are the Australian, the New Zealand, the yen. The pound also is weak. So in looking at these today, let's say you started at midnight. You had a lot of strength in the dollar and the yen. Both of them have a weekly, monthly trend that's slightly up. The yen has a very strong monthly trend. And starting the day off, let's look back on the euro here. It wasn't the weakest at the time, but the Swiss was. So the dollar Swiss would have been an excellent one to buy coming up to midnight. Here you can see, and in fact a little bit even before that, the price is above the hourly right here. It breaks out above the previous day's high, and guess what? As it goes up and comes back down and goes up again, notice there's just less strength the second time, as well as right here. The trade didn't work. You have the previous month's high, which is a major resistance area, and one of our criteria is use the currency meter to find the strongest currencies to buy and the weakest ones to sell, and only take trades that have a 1.5 times risk versus reward, reward to risk ratio. So in other words, if you're going to have a 10 pip stop, you need at least a 15 pip profit target. New traders should always use 2 times bigger profits versus risk. They don't always hit your profit targets. Sometimes they trades that you think are for sure going to work end up with losses. Other times your 20 pip profit target gets shot past and you end up making 40 pips instead of 20. It all averages out. In other words, this trade was horrible for the simple reason that it doesn't meet the risk versus reward criteria, which, very minimum 15 pips profit. If you bought this here at 37, your profit target is only 11 pips up. Subtract from your spread. It doesn't meet the risk versus reward criteria. Now, when it broke out above the previous month's high later and then pulled back, a lot of times currencies will return to their highs. So if you bought this pullback right here when it goes above these bars high around 50, you have 20 pips to go. And if it goes past that, we have a Fibonacci profit target that I do each night. Spend about 30 or 40 minutes analyzing all the main 12 currencies each night, putting the Fibonacci areas up on our server, which then gets downloaded to your charts. And as you can see, I nailed the high today almost to the pip. So if it shot through the previous high, this is your next profit target up here at 78. If you bought this around 49 or 50, you have a good potential of 20 to 30 pips. And a 20 to 30 pip potential profit target makes it worth risking 10 pips. You don't want to ever risk 10 pips to make 10 pips, or even more stupid to risk 10 pips to make 6 or 7 pips. And that's a common mistake that most traders make, and that's why they lose their money. The yen also was quite strong coming into today. I don't typically have up Swiss yen pairs, but let's bring up a Swiss yen chart and take a look at it real quick, just to illustrate how our currency meter works. Weak Swiss, strong yen. And this one also, I don't have all the support resistance on here, but coming up to today, if you sold right here, you can see it just kind of went sideways. Another sideways action when it broke down right here. It only pulled back 10 pips. Currencies that are very weak longer term, if you get a pattern like a double top later in the day, that's a pretty safe place to sell, and you can see that's when the trend began. Sometimes trends don't begin when you expect them to, and they happen, later in the day. The FX Trend Pro is the tool that we have on the other charts. Let me just illustrate. When this was coming down right here, there was a lot of weakness, and all of a sudden it disappeared right here. And if your stop was above here, you always want to move it in half once the trade starts going your way, and you would have got out of that trade with a 5 or 10 pip loss. But notice this trade here, extreme weakness on the way down. The counter trend move right here had almost no strength. This is a very high probability trade, and if you would have had a loss or two earlier in the day, this one trade right here would have got it all back plus some. Notice Fibonacci profit target. If you sold this at 74, your profit target's at 50. So you have a 24 pip potential while risking, 8 to 12 or 15 pips max. It meets the risk versus reward parameters. And notice my Fibonacci area today in the euro dollar nailed the low here. Fibonacci profit target level. Whenever they are underneath the white 2.0 containment bands, typically price will reverse. So if you're seeing the bars come down right here, and notice on these bars right here that's not that weak. See that? Let's scroll back and look at it on a bar by bar basis. You hit the right arrow and you can demo trade this way. Notice the statistical weakness disappeared. The market is 30 pips underneath the 2.0 containment band. Most of the time this band contains price, and when markets have overshot and moved statistically too far, typically at the very minimum they'll retrace 38%. So if you were to buy this breakout of this bar's high here around 5,400, you have a 33 pip potential profit target while risking 10, 12 pips. And obviously it doesn't always go up like that. If it goes up and it has less strength on the way up than it had weakness on the way down, and you're in this trade at 5,400, you're up 17 pips. You're watching this, you're expecting 33 as your profit target. You've already made 25 pips right here. It's statistically strong, but in real time as you're watching this, any sign of it coming real close to your profit target and not being able to hit it, you want to exit at least half your trade. All right, notice it just tagged that to the pip. I would have got out of half the trade there, and also drag my stop up. If I expect it to go, if it had plus 80 or higher strength, I'd have my stop underneath the last 2 bars low. But in this case, the momentum is starting to die down. I'd probably exit the next half of the trade if it moved below that bar's low, which it did. See that? And it really didn't continue on up at all. So maximizing your profit based on what typically happens is a good course of action. Let's see if there's any other currency meter type trades. The pound is also weak today on the weekly and monthly trend. Unfortunately, had a little bit of strength right here. I'm always hesitant to look for sells after extreme strength, especially when it hits the 100 level twice in a row. But once you have some weakness like this followed by very little strength, it's very likely to resume and go in the direction of the weekly and monthly trend. So let's say coming up to 10, you're looking to sell the pound. What's stronger between the dollar and the yen? Well, at 9 o'clock, this one had almost 100 strength. This one had about 85. And then the weakness here was more in the dollar than the yen. So I'm going to go with the yen. I want to look for sells at 10 o'clock in the pound yen. And that's, you want to look for, if there's two currencies that are both strong, pick the one that had the least amount of weakness during the last pullback phase. In some cases, there's no pullback at all and it stays green the entire time. But we want to look for sells in the pound yen coming up to 10. All right? All right, so here, this one is a little risky trade because guess what? Here's the lower containment band. We have a Fibonacci profit target right here, which most of the time it hits. I don't like to sell underneath the lower containment band. And for myself personally, I will rarely sell a currency that's more than 15 pips below here. So coming up to 10, that's at 0.1. Price is down here at 8. It's 15 pips underneath there. I probably would not take this trade because it's also coming up to where the Fibonacci profit target levels are, and I would expect the 1.618 to be the maximum profit. It's less, maybe it's 14 pips. This one has a wider spread. I wouldn't have taken that trade. Earlier in the day, once this thing breaks down, especially when it breaks underneath the previous day's low right here and kind of goes sideways, this is a very high probability trade right here. And because you have a very big profit target below you, it could go to 82. If that's the case, you're going to make over 25 pips in this while risking less than 10. That makes sense. The trade down here doesn't, because it's underneath our lower containment bands by too much. And if it was underneath here with 85, 90, 100 weakness, every once in a while I'll break my rules, but I will trade smaller number of lots when that is the case. While I have this up, let's look at another pattern that's very high probability. It doesn't, when I say high probabilities, it typically leads to trends, but you don't always know the direction. We have a narrow range pattern, which means the volatility was very low for the previous 4-hour period. And then we have another one it's inside the previous one. So two 4-hour narrow range patterns in a row means there's almost no activity for 8 hours, and typically trends begin in that case. Here we have the weekly and monthly trend that are down, but the price is above the hourly. Typically, if the price is above the hourly, we'll want to buy the breakout. But if the weekly and monthly trend are vastly down, it's a pretty low odds trade. If you bought that breakout right here, notice the market came immediately back. You'd exit that trade with a small loss. Once it breaks underneath the hourly right here, you might have went long. Short right here, and your stop would be a few pips above here. It kind of went around sideways for a while, but once the trend finally starts to get going, the fact that it had narrow range patterns earlier means that you're likely to have at least a 2-wave move. So here was the first move, second move, and then it made a 3-wave move down.